Welcome to Level 1 Lesson 1. My name is Ria the Trader from TradingWing.net. Throughout this lesson, you will get a better understanding of what the stock market is, as well as what the stock market is comprised of. A stock market is a group of exchanges that serve as venues to buy, sell, and issue shares of a public company. To put it into better terms, think of the stock market as your local flea market. Think of there being a flea market. However, within the flea market itself, there are vendors. And those vendors typically sell or buy products. Now, how would we contrast this with the stock market itself? Well, think of the flea market as the stock market. Think of the vendor or vendors as the stock exchange. And finally, think of the product or products as the publicly traded company. Now, in order to understand what the stock market is, it is important to get a better understanding of what a stock exchange is, as well as what a publicly traded company is. So let's get started with the stock exchange. Stock exchanges generally facilitate trading in shares. They provide services to individuals like you and I, to traders, and to brokers. In addition, they keep track of price fluctuations and volume. So if there is ever a great increase or decrease in the price of a stock, or if there is a sudden influx of volume, also known as volatility, then typically stock exchanges will choose to halt or put a temporary pause on the trading of that publicly traded company. Halts will be explained in later lessons. And finally, stock exchanges provide a meeting point between buyers and sellers. So if you and I were to go to a flea market and go to a vendor, we can choose to either buy a product or sell a product. And that is the exact idea of the stock exchange. It is important to note that every country or region may have one or more exchanges comprising their stock market. So that means every country has their own stock exchanges. The main focus of the future lessons and this lesson will be the US Stock Exchange, and the leading exchanges are known as the New York Stock Exchange, also known as NYSE, as well as the NASDAQ. So now let's talk about publicly traded companies. Companies don't typically begin public. They initially begin as private companies. However, they can go public through a process called Initial Public Offering, or IPO. When a company goes public, it allows retail investors like you and I to publicly trade it. However, there are pros and there are cons to IPOs. So why would a company not go public? Well, for starters, a company may not go public because they do not want to release their earnings. Because when a company goes public, they are required to submit quarterly earning reports. In addition, they have to respond to shareholder concerns. And finally, they must make senior executive actions such as buying and selling shares of that company public knowledge. If a company wants to remain private, then they must remain private. Now, why would a company go public? Well, there are many reasons to go public. However, the three most important factors for me are to raise capital for further company investments and growth. Now, you may be asking, why not go to a private investor? Or maybe why not go to a bank and receive a loan? The answer is quite simple. It's actually very expensive for a company to go to a private investor or a bank for a loan, and it is significantly cheaper to simply go public. In addition, a company going public actually increases the publicity because people tend to research or do due diligence on the company and learn a lot more about a company that has IPO'd and can typically share this information through social media, which can, in fact, bring in a lot of investors. And finally, going public allows early investors to cash out of their investments. So that is generally what the stock market is.